This conference will now be recorded. This conference will now be recorded.
Right. Good afternoon, ladies and gentlemen. Welcome to another session of Business Environment. My name is IFA Iqbal, and I'll be taking this session for today. This is unit number 1, Business Environment, and today we'll be talking about L01, explain the different type of businesses, their size and scope of organizations. So your L01 says explain the different type, size and scope of organizations. This is a unit, this is one of the compulsory units on your BTEC higher. This you have to complete this unit to progress further. Okay, so what we'll be covering in this unit is we'll be looking at different types of organizations. We'll be looking at their sizes, and we will be looking at their scope of organization, for example, their activities, their businesses, their background. So there are 3 things we need to be covering today. We'll look at different type of organizations. We'll be looking at their scope and why they are there, and we'll be looking at some kind of stakeholders. We'll be looking at some kind of market forces. We'll be looking at their legal structures. So this is the idea. This is the lesson for today. All right. So I hope that you'll join. Can everybody hear me? If there is any issue, please let me know, and we'll try and put it right. Okay. So let's start with the first bit, business. What is a business? A business is an organization, economic system where goods and services are bought and sold for money. Right. In the olden days, it used to be a barter system. These days, it's a currency system, and we get the goods and the services that we need. Okay. People go to the market, they exchange currency, and they get their goods, they get their services, and everybody enjoys those goods and services, or they don't. Depends on the nature of them. Okay. Everybody who buys goods and services make sure that they are there for their need, and they are there for their requirements. Goods are bought for their necessities, goods are sold for profit, goods are manufactured for profit. So the businesses mainly making money because of the selling goods and services. They are there to make money because they have invested in there for business. They have made their investment. They produce goods and services because the demand is there. They want to sell it. They sell it to the market. Market is a place where people come and buy those goods, and businesses sell those goods for a price. Okay, so this is what a business is. A business is there to make money because they have invested in certain sort of business, whether it's a small business or a big business. They have put money for their to make a long-term profit. That's called investment, and they want to get a return. How do they get return? They want to sell the goods and services in a market. What's a market? Is where buyers and sellers come together and exchange goods and services for some kind of consideration. Okay, business can be a small business, it can be a large business, it can be a very large business. Okay, so small business, for example, a business can be a barber shop, for example, one-man business. Okay, a business can be a bigger business, for example, a limited company. It can be a multinational company, a bigger company which has businesses in many countries. Okay, in international businesses and so on. Okay, so it can be a small business like a barber shop, like a butcher's shop, like a cleaner, for instance, like a tailor. That's a very small business. And a big business, it can be a company, it can be a company like a Coca-Cola company, it can be a very multinational company like a Coca-Cola company, Pepsi-Cola, Toyota, okay? And it can be some kind of a form. In the middle, there is other types of businesses. They are called partnerships. There are partnerships, and there are private limited companies. So let's look at different types of business. One type of business is a sole trader. The first thing, as I explained you, a butcher, a candlestick maker, a tailor, right? All these are sole traders. They're one-man business. They have their own employees. They are there for making profit, of course, and they have their own investment. They have their own resources. They have their own services, goods and services, and they go their business on their own, sole trade, on their own business. They have nobody to report to. They are self-made. They are self-governing. They are there to make money for themselves, right? This is called a sole trader, right? He or she has a business of their own, and they have advantages, they have disadvantages. Advantages like, for example, they keep all their profits to themselves. Disadvantages that they don't have anybody to tell what to do, how to do it. They are their business bosses themselves, but they are also, self and time managing themselves. So they have to be good organizer. They have to be a good managers. They have to be relying on themselves rather than somebody telling them what to do. But the problem is, if they go sick, what do they do? Who looks after their business, right? Who do they tell to look after the business? So there are disadvantages and there are advantages, but he keeps or she keeps profit when they made profit, but he doesn't need to pay any tax if he doesn't make a lot of profit. He doesn't have to register with the tax authorities. He or she doesn't have to pay corporation tax or anything like this. So these are some of the advantages. Very cheap format of creating or setting up a business. However, there is disadvantages like time consuming, and he has unlimited liability, and he goes sick. Who does he look after? How do they manage the business, and so on. So therefore, is very limited in its scope. Okay. Partnerships are where are two or more people go in business together. They have formed the partnership because they want to share risks. They want to share some profit. They want to share losses together. Examples of partnership, for example, solicitors, doctors, dentists, accounting firms, architects, right? Professional organizations mostly go into partnerships. So therefore, the expertise are there. They are bigger, they are better, they are more specialist, and they share their profits and losses equally. But still, they have unlimited liability. And then the third type of a business we look at is the limited liability company, where we have a company goes incorporated, right? They have limited liability. There are managed direct. There are many directors, one or two directors in a company. Then there are limited liabilities. They are separate legal entity to companies who form them. So therefore, they have an advantage of limited liability and legal entity they are. So therefore, they are much more advantageous than the sole traderships and partnerships. Okay, so this is a general. And then we have multinational companies. We have national, organizations and so on. So let's look at them also. Okay, one of those small businesses is called non-for-profit making business. Okay, they are like charities, clubs, non-government organizations. These are the organizations that are there not to make any profit, but to make some services, to make impression on the society, to give services to society, like, for example, Islamic charities organization like Red Cross, for example, or like, for example, organizations like Christian Aid, right? Or animals rights groups, for example. These type of or YMCA. These type of organizations, they are regulated by the Charities Commission, most of them, and they are registered there. So they are regulated by accounting bodies as well. So they have to register their accounts with them, making sure that they are not making any profit out of their, uh, you know, out of their services. How do they get set up? Is they get funding from people, they get subscriptions, they get people, individual subscriptions, they pay them, they join them, they pay annual fees, and or they just collect it from the general public, get funding from crowdfunding, for example. Right, these are all charities, and they are regulated by the Charities Commission of the UK, and they must be giving services to what their purpose is set up for. Okay, therefore they have to have an annual audit of their accounts, and um, because they are non-profit making, they don't have to produce um, accounts, but they produce income and expenditure account rather than a proper profit and loss account, which is called the financial statements. There are not financial statements. In this case, they produce their income and expenditure account, which is a little bit different because they are for non-profit making organizations. Other countries will follow different practices, but idea is same. They are one of the non-trading organizations. Um, okay. Another trading organization we talked about is limited liability. Right? Limited liabilities is where companies are limited, where they are formed by directors. They get their money from their uh, directors. They are registered with the company's house. They are regulated by the accounting bodies. They have to file their accounts um, with the registrar of companies. They have to have a certificate of incorporation. They have to you have to get the certificate and display it on their in their office. Make sure that the limited liability is displayed by them. And if they are not limited liability companies, they are not limited liabilities because they are not registered. And if somebody says they are registered, you need to ask them, where is your certificate of incorporation? And if they can't produce it, then they are not a limited liabilities company, and one must be very aware before investing in those companies, especially public limited companies. Private limited companies are owned and run by private individuals as directors and so on. Okay, but their main advantage, both of these companies, their main advantage is that their limited liabilities. Limited liability is such that these companies cannot lose money more than what they have their share capital. So if their share capital is £1 and they borrow £100,000, the most they will lose is £1 because that's how their share capital is. They have a limited liability. That's what they can lose. Okay, and that's the most. So one must be aware before investing in those companies. Main disadvantages are they are expensive to set up. It takes a long time to um, get a registered company. They are expensive. They have to form registration costs. They have to pay for registration costs. They have to file their accounts annually. They have to pay taxes. They have to appoint directors. They have to pay fees to the accountants. Sometimes private limited companies especially, they may not be able to afford um, you know, uh, these expenses if they are not making a lot of money. However, the law requires them to follow these regulations, and they must be formed according to the law, right? Where do they get the money? They get their money from their owners if they're a private limited company. They get their money from public if they are a public limited company. Private limited companies, they keep all their profits to themselves, but they are limited in the scope of expansion maybe, or expertise and so on. Public limited companies, they get their money from the public. They are on stock exchange. Some of them are not listed, some of them are listed, but they can get their funding from the public by asking them to fund their organization. Okay, and so on. So these are the types of limited company, and you need to read up a little bit. Okay, so we looked at a sole trader. We looked at limited companies. We compared them with limited companies. Third type of a business organization is a partnership. These are, I've told you a little bit about them before, but partnerships where two people or more than two people come together with a view to share business risks. They join business with a view to share profit and losses equally. They do their responsibilities of running the business equally. They must bear the losses and shares 50-50. They must, if there is no agreement, the basic underlying act for the partnership is 1890, which is applicable to the partnership. Okay, if there is no agreement, then this act applies. If there is an agreement, then of course you follow the agreement, right? This partnership act tells you that the profit and shares, when they are in partners, they are shared profit equally. There's no salaries, there's no interest on capital, there's interest on loans, there's duties are shared and equally. If there is an agreement, then the partnership is run according to the agreement, whatever the agreement may be. Okay. If there is no agreement, then the Partnership Act 1890 applies. Okay, so this is very important, and this is called the Partnership Act. And if you have an agreement, that's called the Partnership Agreement. Okay, so the risks and the benefits are shared equally when there is no agreement. Okay, and you can have two up to 20 partners. Maybe these days there is a limited partnership as well. It depends whether you want to go for limited partnership or not. Advantages of partnership are risks are spread equally. There are more people to share losses. There are more expertise in the business. They're easier to raise some finance because one person maybe knows the other person or somebody else, or they get their friends to invest in, and they become in partners. Okay, so the skills are shared, the duties are shared, the management is shared, and somebody goes sick. If one partner goes sick, the second partner can take over, and so on. So these are the advantages. However, the disadvantages that these people, there is no limited liability. So if somebody goes bankrupt, then of course the second person, has to bear the costs. Okay, the people who are, they have to be liable for all these costs. Doesn't really matter whether the first person paid or not. They both, because they are both partners, because they are both sharing the business ownership, they have to bear the losses as well as. Okay, so that's the disadvantage. There is no there's no what you call the liability. There's no limited liability. There's no security for people. There's if there is anything goes wrong. Okay, if somebody dies, of course, then either the partnership dies with them as well, or partnership has to take on somebody else, or maybe the partnership has to close, okay, or whatever. Okay, so therefore these are some kind of the problems with the partnership. So you got to be aware. Hello, can you hear me, Fizan? Hello.
Yeah, I can hear.
Okay. When did you join me?
15 minutes ago, 14 minutes ago.
15 minutes ago. Any questions? There anything that you want to ask me so far?
Not at the moment, no.
Are you sure?
Yep.
All right. Okay. Thank you for joining. This is very important. This is very good. So I've been talking about the partnerships and talking about the different types of business. We talked about the sole trader, limited liability, and we talked about the private and public limited company. Yeah. So can you see my slide as well?
Yeah, I can.
Okay, so if there is any issue, please let me know. If there is anything that you are not understanding, anything that you're not with me, then you please just raise your hand or please raise your question, and I'll hopefully give you the answer if I can.
Okay.
All right. So we are up to now. We've talked about the sole trader. We talked about the partnership, limited partnership, advantages of company and limited company. Examples, different types of businesses, and different forms of companies have different regulations. Most, if you look at the companies now, we look at the Companies Act, but mostly these Companies Act are governing the private limited companies and public limited companies. Okay, so these are the companies which are registered in England, in the UK, with the registrar of company, and they must follow the requirements and regulations of these acts. As I told you, they have to pay a certain kind of fees. They have to pay legal fees, legal costs for forming. Although one person or somebody who wants to form a company, they can also buy it off the shelf, which are cheaper. However, they might not suit their needs, and they have to adopt. All of these companies, private limited companies and public limited companies, must follow the company's law, because they are legally bound to follow these laws. Okay, they must file their accounts. They must be accounts must be available for public inspection. However, if you're wanting to view the public wants to view the accounts of a private limited company, they may be refused, but you have to ask the partner, or you have to ask the registrar with a fee. They have to pay a certain kind of fee before they can review their accounts. Okay. However, the public limited companies, their accounts are viewable by public anytime. Published accounts they can, and those accounts must be given true and fair view of those accounts. Okay. There are directors as opposed to partners or sole traders. These are called directors in the companies, and these directors have limited liability. In other words, these people are separate legal person to the company that they are forming, so they both are different. The company is like a legal person, and the person who has formed the company is also a legal person, so the both entities are different. While the company has a limited liability, the director may not have a limited liability or whatever. Okay, so this is the distinction. Limited liability is very important concept, lifting the veil, and you need to understand the liability. What is the limited liability? Is the amount of money that you can lose in case of one company goes bankrupt, and they are not bound to pay more than their share capital. Okay, so that's what a limited liabilities or limited liability is, and their account must be filed with the registrar of company. They are found by the company's They are bound by the Companies Act, and they are expensive to form, and so on. All right. So having looked at these type of quickly, I'm sure you've read them in the past about these organizations or these types of businesses. So what we need to look at, just to summarize, the type of business we're talking about. We're talking about the individual individual businesses, i.e. sole traders. We're talking about partnership. We're talking about corporations or limited companies, and we're talking about the other types of businesses like NGOs and so on and so forth. Okay, multinationals and companies, organizations. Main advantage of a sole trader is very simple to set up, decision making on his own. He manages his own time. He keeps his earning. He may pay taxes on the business. He may not pay taxes because he's a personal, his income is considered as a personal income because of his business, and himself are one and the same. He's a manager of his own. He doesn't need to consult his other people. He is his own boss, and he is his own decision maker. He comes and goes and opens the business as him when he likes, takes the day off when he likes. So he, in fact, there are a lot of there are advantages. He's a self-employed. In other words, he pays taxes as a personal person tax pays rather than a company or a business. So there are a lot of advantages of opening a business on its own. But disadvantage is if he goes sick, if he goes ill, if he goes to buying goods and there's nobody to look after him, so therefore he needs to employ somebody else to manage his business, right? If he dies, the business dies with him. If he has borrowed a lot of money and he's unable to pay that money, his liability is, he has no limited liability. He loses everything. As there was one example a couple of weeks ago, I was reading in the newspaper that this person was a hairdresser, and he owed a business money to somebody because his employee took him to court, and the court fined him, and he didn't have much money to pay the court fine. So therefore, he ended up, closing his business because he didn't have any money. So therefore, if he doesn't have any money, he ends up closing his business. But if he still owes the money, then he has to sell his house, he has to sell his car, or he's got to pay from his personal savings. Therefore, he doesn't have to, he can't really relinquish his debts until the debts are paid off completely. Because he has no limited liability. But if it's a business considered as a partnership or a limited partnership or a limited company, then he's protected. Then the most he loses is whatever his share capital, whatever he's contributed into the business as share capital, and doesn't lose anything else. So therefore, he's got a lot of protection in that limited liability. Okay, so the disadvantage is quite a big disadvantage in the case of smaller business. We looked at partnership. There's two types of partnership. One is general partnership or ordinary partnership or partnership, and there's the limited partnership. Advantages of partnership is share of risks, share of expertise, share of duties, consultation, and so on. Earnings is shared, but it's easier to set up business as well. But more capital, more expertise, the time management shared. So one person can take a holiday and the other can run. The disadvantages, again, there is unlimited liability. There can be disagreement between people. There's a problem raising more capital. There is a partnership issues. Maybe there is a problem in the decision-making process and the disagreement. Maybe if there is no what you call them agreement, then the Partnership Act 1890 applies. But it's better to have a partnership agreement there and then, so that everybody's clear. We looked at the corporations or limited liability companies. There are two types of companies. One's a private company, one's a public company. Okay, you look at these type of companies where their limited liabilities, the most they lose is their share capital, up to the share capital and nothing else. Okay, so their house and their cars and their other things are, protected. They are more, secure. Limited liability is very important. You can read about lifting the veil. Why is it important? What do you mean by limited liability? People who form the company, they are completely different people who are the directors of the company. So they're both different, and they, directors have limited liability. The company is very important business, so that they, form are legally bound by the Companies Act, and it's important that they are bound, because people who are wanting to do business with them must be aware that these people, these companies are limited, so they have an extra protection, the public as well as the private. The disadvantage is they're costly to set up, and it's very, it takes long, time consuming. They have lots of documents to file. They must file their articles and memorandum of association with the registrar of company, internal and external document, which is the memorandum of association deals with the external world, whereas the articles of association of this company deals with the internal management, the running of the business. So therefore, when you are incorporating a limited business, you have to file these articles of association and memorandum of association, and all the details, the registered office, all the internal management, all the meetings, how will meetings will be held, where they held, where's the registrar, where's the meetings registered, so on and so forth, got to be kept within the business. Okay, so these are quite detailed documents one has to file and one has to read. Okay, so this is a general overview of the businesses, and you have to read, go more deeper into the business and reading into the book as well as. Okay, any questions on the types of ownership so far?
No questions.
Okay. May I ask, have you read economics before, environment business? Did you read it before as well, or you just new to the business studies? What's your background, if you don't mind me asking?
The last time I did business studies was GCSE, and that's all
Okay,
pretty
right,
much. Yeah,
right.
and
So,
A level I did more like IT, chemistry, and
right, right. So you don't know anything about business partnership like this.
yeah, like when you speak about like the sole traders, private limited companies, and so on. I know I have that like base knowledge from GCSE, but I don't have the
Right. Okay.
A level, I guess you could say.
Right. So what you need to do is read a little bit on the, about these types of business ownerships, right? Because when you go and do the assignment, they need to have a bit of detailed knowledge of these. We can't cover in 1 hour session too much. All right.
Yeah.
So the next thing we need to look at is the demand. Okay, we need to look at the supply and demand, i.e. the people getting into the business. We need to look at the market system. We need to look at the law of demand, law of like this, because we're talking about the businesses. We need to look at what is a business, what do they sell, what do they produce, who buys them. So basically, we need to look at demand and supply. There is somebody who wants to buy the product. There's somebody who wants to sell the products. So therefore, the demand and supply is got to be in the marketplace. We need to study the market. We need to study, and that studying the market is known as the demand and supply in the market. Okay, so the demand and supply. Demand is the demand and supply is where producers come and sell their products and where buyers come and buy products. Okay, so this is the demand, is where the people or the general public goes and buys these goods for a price, and the supply is where the sellers want to sell in the market for a price. This is what a supply is. Okay, so the law, we need to study the demand and supply a little bit separately, but they are also we need to study them together. Okay, so the first element of the market is to study the demand. Okay, now the demand is something when consumers, i.e. the people who want to buy these goods, they are called consumers, buyers. They go to a market to buy these goods at a particular time for a particular price. Okay, so the demand is something that consumers are willing to buy at a given point in time at a particular price. This is known as the demand, or effective demand, or aggregate demand. Okay, aggregate demand is the total demand, i.e. the total demand of goods and services demanded by the buyers, demanded by the consumers. Okay, so therefore that's what it is. So if you want to buy a Rolls Royce, this is a product you go and buy from a market or from a showroom, or so if one person buys this product, this one consumer, if many people want to buy this product, this is called consumers or buyers. Okay, and the total of those buyers, whatever they demand in total, that's known as the total demand or the aggregate demand. Okay, and what they are willing to pay at that particular price. So the law of demand, you need to look at the law of demand determines what as the price of Rolls-Royce rises, then the consumers will be not interested in buying that particular price because they don't want it or they can't afford it. However, the price, if they reduce the price, then of course people are willing to buy it more. Okay, or if you look at the price of butter, for example, if the price of butter rises, you want to buy more of those butter rather than not. Okay, so the basic law of demand is says the more you will buy more when the price goes down, you'll buy less when the price goes up. So this is the law of demand, a contraction or expansion of demand. Okay, the law of demand looks at this price. There's a relationship between a price and a demand. Okay, and it depends whether it's a necessity, whether it's a substitute, whether they are complementary goods, or whether they are what type of luxury goods or whatever. Okay, so if they are goods of different types, then of course the behavior will change. Right, necessities, for example, are goods that are food. For example, if you buy food, that's a necessity, but if you want to buy a Rolls Royce, that's not a necessity. Okay, so depends on the types of goods. Certain goods will be having a lot of demand and certain types will be having a lot of less flexible demand. Okay, so therefore we need to look at the demand in different sections. Okay, so demand depends on the type of goods we buy and the services we buy in particular section of the market. Okay, so that's so the necessities are always go up in demand regardless of their change or reduction or increase in price. Luxury goods, of course, they'll be affected by a price rise or price fall depending on their rise and fall of price. There are complementary goods. For example, if this is Rolls Royce, if you want to buy a car, of course, your demand of petrol or your demand of goods like tires, because they are complementary goods, they are go hand in hand with the car, their demand always increases as well. Okay, so it's very important that you distinguish these demands. So let's look at the type of ownership. Let's look at the demand, for example, demand and supply in the market. If you look at this one here, for example, the demand of a particular good, like an ice cream, for example, or whatever. Okay, if you look at this quantity demanded, the price of this particular plant or product or yogurt, for example, if the price of yogurt at particular time price is 10, people want to demand 20,000 pots per week or 20 yogurts. If the demand rises to 22, the price, of course, will rise, okay, because if you look at the supply side. But if you look at the demand, if demand falls to 18 because the price has risen 15, okay, so when the price is 10, people demand more. When the price rises to 15, people demand less. When the price rises even more to 20, their demand goes down. And when the price goes up to 30, price per pot of yogurt, the demand goes to 12. So from 20, when the price was 10, to 12 when the price goes to 30. So there's an effect on the demand. So this tells you that there is the law of demand tells you that as prices rise, the demand of a particular product falls. All right, and this is the basic demand. Law of demand determines this because this is what happens to any good. However, as I said, there are different goods. This might be applicable to a different good. However, it might be applicable to if the necessaries, if there are food, even if the price rises, the food demand still rises, never falls. Okay, but if this was a kind of a luxury good, might be that the demand will fall and so on. Okay, so this particular quantity demanded, okay, will fall as the prices rise. Okay, so you can watch a video of a particular theory of demand on this tutor2u.net/economics/reference theory of demand. Okay, and that will explain to you the demand, how the market works. Okay, the law of demand. You can draw up a curve. You can draw up a demand curve which looks like this. Okay, on the one hand, which is on the horizontal axis, which is this one here, quantity demanded, and on the particular vertical axis is the price, right? So as the price rises, you can demand starts to fall. As the price rises, the demand starts falling to the right hand side. Okay, so it goes the price and the quantity demanded. So the basic law of demand tells you that the demand will lower when the price rises. Okay, so this is what a typical demand curves look like. Okay, are you okay with this? Okay, Faizan, any question? Are you okay with this? Or...
Yeah, I'm okay.
All right, okay. Thank you for being with me. Okay, so let's move on. So this is basic demand. As the price rises, the demand of a particular good falls, and it looks like the demand curve looks like this. Okay, now going on to here. Okay, the conditions of demand, as I told you, if your price rises, then the demand falls. Depends on the nature of goods. Certain goods are complementary, certain goods are necessities, certain goods are luxury goods. Okay, it depends on what type of goods you're talking about. Okay, the demand, basically the components of demand is dependent on your income, on your price of a substitute, on the complementary price of complementary products. It depends on the nature of product. It depends on the tastes, fashion, population, changes in prices, changes in fashion, income, or age maybe, or population, and so on. So the demand depends on many factors, and it depends on whether you are looking at the substitute goods, or looking at the complementary goods, or you're looking at luxury goods, or you're looking at gift goods or necessities, right? So what it is, the more that brings us to the price elasticity of demand, i.e. what it means if your price changes more, if you're increased a little bit of price and it results in more fall in demand, that's known as the elastic good. Okay, so the price elasticity of demand is a kind of a law, is a kind of a calculation, is a kind of a formula which you have to calculate, because you need to know what is your demand, how effective or how sensitive your product is in relation to price rise or price fall. The more, if you increase a little bit of price and it results a lot of fall in demand, that what we know is it's very elastic. Okay, i.e. it responds very quickly, i.e. people will not buy of that product because they are sensitive to a price. However, if there is a little bit price rise, but it doesn't result any fall in demand, then that price is known as the inelastic. Or if we keep on raising the price of that particular product, there is no effect on the demand keeps on increasing, then that product is inelastic. So what I'm trying to say is, for example, if you increase the price of chips, for example, people will still keep on buying those chips because they have to buy, because they have a necessity. They want to eat, they want to live. It's a necessity, it's a basic staple, it's a food, right? And the demand will still keep on rising. It has no effect on the demand. Okay, and so a little bit increase in price will still keep on rising the demand. So that's a price, what we call the price inelastic. Okay, if on the other hand, if you raise the price of, for example, certain types of goods, like for example, I don't know, price of, for example, trainers, right? And people buy less of those trainers, then there is a effect on the demand. So that's more elastic. Okay, so the elasticity and the inelasticity is the concept that you look at when working out the demand of particular good. And this is calculated here using the formula, is percentage change in quantity demanded over percentage change in price multiplied by 100. So if you have a more percentage change in quantity demanded divided by the price, and if it's more than 1, the basic formula, if it's more than 1, that's known as the it's more than 1 means it's price elastic. Okay, and if it's less than 1, it's a price inelastic, and if it's a 0, it gives you no changes. Okay, the price elasticity, if it's because you're affecting more, if you're what means by these products will be demanded less because you increase their price. So in that particular case, these you have to be very careful when you increase or decrease the price. So if there's like the goods we call them plastic good. I'm saying the inelastic goods, like for example petrol. We're talking about the necessities, i.e. the food. These products will go on. People will go on buying them regardless of increase in price. and these are known as the inelastic products. Whereas certain products, other products like luxury goods, for example, people will buy less because they don't need those, and they are called elastic goods. Okay, and then certain goods are known as the zero elastic. So what I'd like you to do, you can calculate this activity if you want. You have access to Moodle. Okay, so if you want to calculate price elasticity of demand, there is some exercise. Maybe this presentation will have an exercise, so you can calculate the price elasticity of demand by calculating a rise in price and divided by a rise in demand, multiply by 100. You can calculate them in percentages and see whether they are elastic or whether they are inelastic. So for example, the first activity says the price of a product has increased from £5 to £6. As a result of quantity demanded has fallen from 20,000 to 10,000. So you can calculate by the 5 from £5 to £6. That's a rise of £1. Okay, the demand has fallen from 20 to 10,000, which is 10,000 units have fallen. So you can calculate the price elasticity by calculating the percentage and see if they are elastic or inelastic. The other example is here. The price has increased from 4 to 450, and the demand has fallen from 50 to 49,000. You can still calculate and see what the result is. Okay. All right. So they will give you the result of that particular. The second component of the demand is the supply. Okay, the supply is where producers are willing to sell products at a particular point in time at a given particular price. So this is what supply is. So if you look at the price here, if the price is low, the supplier is going to supply less. If the price rises, then they are willing to supply more. Okay, so if price is 10, the suppliers only want to supply 12. However, if the price rises to 30, then they are willing to supply more of that particular product up to 20. So that tells you the law of supply is the more the price, the more the suppliers are willing to supply because they want to make profit. Okay, where these both meet is the known as the law of supply and law of supply and demand. But before look at the law of supply and demand together, this is how a curve looks like. This is what a curve of supply, which is going from the left to right. Okay, so this is a supply curve going from left to right. When we join them together, when we join the supply curve with a demand curve, this is where we have where we meet in an equilibrium. We will look at that. The causes of supply. What causes supply is the level of technology, price, production, the weather, the taxation, the technology, the objective of business, right? What conditions are there? So the more better the weather, the more product will be supplied. The higher the price, the person who's selling those goods will flog more onto the market. The better the technology, the faster the production will turn, and then he wants to sell the more. All these factors will affect the supply. Okay, then we need to look at the supply factor, which is the price elasticity of supply. So you can have a look at that as well. Okay, and then this one here, supply and demand, when they come together, that's known as the equilibrium. This is where it is the supply and demand then they meet. This is known as the equilibrium, which is the equilibrium is where the people who come and buy and supply goods are meeting at a particular point, at a particular price. Quantity demanded will be, the same when they both buy and sell these goods. Okay, so this is where they meet. This is where the supply and demand meets. This is where they both agree, which is supplier and buyer and seller, and this is where they call equilibrium state of business, or supply and demand will be equal to equilibrium. Okay, so quickly you can look at the tutor2u.net market equilibrium, and you can look at the case there. Okay, the next thing we need to look at the stakeholders. Okay, and I'm sure you know what stakeholder is. You can read about stakeholders. Stakeholders are people who have a stake in the business themselves. They have say in the business. They have a run. They have an influence in the business. These are the people who are internal and external influencers. They are the people who can object or accept what the company wants to adopt or whatever. These are the people who have have an influence of some sort. There are internal and external stakeholders. Stakeholders are individuals. They can be government, they can be organization, they can be local community, and they can be employees, they can be your pressure groups, they can be management, they can be a number of them. Some are internal and external. Okay, and very important to look at the internal and external stakeholders. Okay, what do they need? What can they influence? How do they influence? You can look at them on the net. Okay, and see what their why they are interested is because they have different interests in business. For example, if you are a small business and you want to open a small business in a local area, maybe the local people don't want you to open a business in their area because it will disturb them. It will disturb their sleep, or it will cause noise, it will cause a lot of traffic congestion. So they can apply to the council, this business should not be open in our locality. And of course, then you have, you can't open the business there if the local people don't want it. So local people are stakeholders. Okay, so that's why it's very important to have influence on the stakeholders. Very important. If you want to open a school in the local area and the local people don't want the school in their area, they cannot open because it disturbs them, causes pollution, causes noise, and a lot of people and so on. So you must look at the internal and external and the influence of these stakeholders and secondary and primary and all this. Okay, so I think it will be better if you can read this particular slide on there. Okay, so I'm going quickly through this. Okay, there is that's stakeholder impact and the stakeholders interest and the type of stakeholders. So if you look at this, you can have a look at the stakeholders on the notes. Okay, if you want to look at how the prime mark is affected by stakeholders, you can make an activity. Okay, so I'm just whizzing through very quickly. All right, there's a video on there as well. Okay, I think what it is, I should stop at this. Okay, I've gone very quickly through the stakeholders, and you need to read up a little bit on stakeholders, their influence, who are the type of stakeholders, what type of engagement do they have, and how the prime mark, for example, if you take an example of prime mark, what type of stakeholders do they have, internal and external, and the influences they have on the business. Okay, in this basic overview of the type of businesses, the type of organization we were looking at, the LO1 basically looks at your business in a general sense. So because we set out to do it was look at the different types, scope of business, different types, different sizes, different scope of business. So what we looked at the nature of business. We looked at sole trader. We looked at partnership, limited partnership, limited companies. We looked at NGOs. We looked at charities. You can look up at charities as well. So we looked at examples of small trader. We have looked at the partnership, for example, when two people getting together in business. We looked at limited liability company when one or more person forms into a company. So a private limited company and then a public limited company. A private limited company is owned by one director or more. Public limited company, of course, like an example, like Coca-Cola, or a bank, that's a public limited company. NGOs is like a Christian Aid, for example, or Pressure Group, for example, or YMCA or Islamic Relief. Okay, sole trader is like a barber, and so on. Okay, so then we looked at the supply and demand. Okay, supply is where a lot of suppliers come together to supply these goods. Buyers come together to buy these goods. That's known as the demand. We looked at supply and demand. The higher the price, the lower the demand. The higher the price, the more the supply. And we looked at supply factors and demand factors. And we looked at demand factors like income and tastes. We looked at supply factors like technology and weather. Okay, and we looked at the price elasticity of demand, i.e., if there is a lot of increase in demand as a result of lowering of price, that's known as the inelastic. And we looked at the elastic one. The formula is, if it's greater than 1, it's elastic. If it's less than 1, it's inelastic. If it's a 0, that's a unitary elastic. Okay, and lastly, we looked at stakeholders. We looked at the type of stakeholders, quickly, internal and external, how they can influence the business. And we said you can look at the different types of stakeholders by watching the stakeholders influence and looking at the video and going on to how one company like Primark affects their stakeholder, or how Primark is affected by the stakeholders in itself. Okay, so the basic lecture is formed around explaining the different types of business. So that's a business environment. Okay, so if there is any question, please let me have it. If there aren't any questions, then I can close this session. So what's the situation there, Faizan? If you have any questions, or you're okay? Any question? Anything that you're confused or?
No questions.
I mean, that was a quick run over of the types of businesses. So you need to read a little bit more on your own because we can't cover everything in a particular session. However, if you these textbooks, if you got notes on Moodle, you go and research on the website. You go and read the business organization textbook. Then I'm sure you will get the grasps of this L01.
Okay.
All right. So can I stop the recording? Thank you very much for joining, and I hope we'll meet tomorrow. You have a lecture tomorrow as well, L02, yeah?
I'm not sure because I think Graham wrote in the chat that this session was for me and Hira, and I think the next session was for Nandish and the other guy. But I'll just ask.
All right. I have a session tomorrow. I don't know whether you're registered for the business environment. I don't know. You may be not. But there is one session tomorrow, L02. So if you're registered, of course, you're welcome to join. If you're not registered, that's I don't know how it works. Okay.
Yeah. What I think he wrote in the group chat was Saturday will be group 1, me and Hira, and then Sundays will be Noora and Nandish, 2 p.m. UK time.
Right. Okay. Right. That's good. No problems. Thank you for joining, and have a good weekend. And we'll see you next week. Okay. I'll just stop this recording before we and have a good day. Thank you.
Right.